U.S. apartment market is starting to send some mixed signals. We're going to take a look at that in today's episode of Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. And Greg, as we talk to folks around the industry these days, I would characterize the tone as cautious exuberance. Everybody's excited but also nervous about what might be happening, when things might finally slow down. So we're going to look at maybe some signs that things are changing a little bit today. We've also got a lot of good news. We also want to talk about some things that maybe we should be watching for.
And we're going to start off with that note of caution and some things in the first quarter results that were not stellar. And let's begin with, it was a pretty weak demand period. So across the nation's 100 largest markets, we absorbed 20,077 units during the first quarter. For comparison, that's less than half of the first quarter demand that was seen back in 2015 as well as in 2014. So again, very much on the weak side there. And then comparing that figure to completions, way under the completion number, the 3-month delivery tally was 65,258 units.
So Greg, what do we think happened there? The underlying job numbers still look healthy. That should suggest continued household formation, housing demand. So what happened in Q1?
It is tough to trace this weak demand back to any specific influence. And from my perspective, it's a general sort of thing, and that people are getting nervous about the economy, nervous about what lies ahead. Certainly the stock market has been incredibly volatile lately. If you look at some other signs of what's going on, just before we walked in to film this video, retail sales came out. They were pretty weak. If you look at the political environment, it's kind of weird in country after country, including here in the U.S., where we are having the oddest and particularly the loudest presidential election campaign that we've ever seen. So a little bit of nervousness. And whenever you're uncertain, you kind of freeze up, and the tendency is to do nothing. And we're seeing that do nothing in some of the stats that are coming out about the housing market. The first quarter home sales number was a little bit weak. Certainly people are hunkering down in the apartment sector, and you look at the conversion whenever leases come up for renewals. We just set an all-time high for that conversion number. 55% plus of the leases that came up for renewal in February, folks remained in place. There is seasonality there. The February number is going to be the highest that we're going to see all year. But again, that's just a really big number of folks staying in place and doing nothing.
So with demand falling short of completions, that obviously meant a hit to occupancy. Let's take a look at that with this chart. The average occupancy figure across the country's 100 largest markets came in at 95.7%. That's down 20 basis points on a quarterly basis. Now, of course, that's not a big decline in the resulting occupancy rate of 95.7. That's obviously still very, very good by historical standards. But the pattern is significant, since the normal seasonal pattern for occupancy is to rise slightly in Q1 after a seasonal slowdown in Q4. And here are a couple of charts for you showing the weak demand and the slight side in occupancy was seen pretty much across the nation in Q1. First, let's look at the number by region. Occupancy dipped 30 to 40 basis points in the Northeast, the Midwest, and in the South. The West was steady, but even there you didn't see the normal seasonal uptick. And second, occupancy trend downward a bit in markets of all sizes. The biggest metros saw the most pronounced declines, 30 basis points on average, mainly because those are the spots where the building activity is most aggressive, with a lot more product in initial lease-up. But occupancy also slipped about 10 basis points in the next 50 markets in size. And in those areas, the storyline is almost entirely about demand rather than supply.
So Jay, at the beginning of the video, we said mixed signals. So we've talked about some weakness, but that means mixed signals means something was really rocking, and that, in fact, was the rent number. So let's look what happened on a quarterly basis for rents, and we're seeing that effective rates for new leases are up 0.9% in the nation as a whole. That number, in fact, beats what we did in first quarter of the previous 3 years. So a really solid result. And as you talked about, some weakness across the board on occupancy, it was strength across the board when we look at the rent numbers. So let's again break it down by region. We're at 1.3% quarterly growth on rents in the West, 0.6 to 0.7% in the other three regions. Again, looking at it by market size, 0.9% growth in the 50 biggest metros, 0.6% quarterly growth in the next tier of markets. So really strong rent growth numbers for the quarter. We translate that into annual change. We are at 5% even rent growth year over year in these largest markets. So a terrific story, and really no loss of momentum for the moment.
Yeah, and for the moment's the key phrase there. Touching on what those Q1 results really mean in the big picture, it's important to note that Q1 is really not that important for overall profitability for apartment owners and operators. There just aren't many leases signed in the Q1 period in any given year. Most leases are going to get signed in Q2 and Q3, so obviously these next 6 months are going to be very, very important for the U.S. apartment market, and that's when the money is made. But what happens in Q1 does, of course, set the tone for the remainder of the year and speaks to the general momentum that we're seeing. And having a good Q1 last year certainly led to a much bigger performance throughout 2015. And it'll be interesting to see what happens moving forward.
It will, and these Q1 numbers do suggest as we get into this peak leasing period that demand is maybe not going to be as strong as it has been over the previous couple of years. And while that hasn't really weighed on the rental rates yet, I think it will as we move on through this cycle if we still continue to get demand that is less than just overall economic growth would suggest. And that's not really any different than what we've been predicting. As we came into this year, we did say that rent growth would slow down to around 4% rather than around 5%. So not a big surprise here, but it is a story of losing some momentum.
Yeah. So yeah, as you said, not a huge surprise, certainly something we expected to see. But of course, we'll watch those numbers very closely moving forward. That's going to wrap us up for this episode. But as we move forward, we're also going to be highlighting individual metros. We start to see very different performances in certain spots across the country. So until then, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics from NPF Research.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.